Thank you again for giving me the opportunity to participate. Pete, this is a great new space. I just don't like this setup because now I am looking at myself. Oh yeah.
It's not such a scary sight. Don't worry.
As I've said multiple times, a face made for radio. So sitting left, my left, your right, we have Lindsay Rubenstein, Ellen Baker, and Mark Heil. And I always feel that the best way to start a panel is letting them introduce themselves and not let me introduce them. And then take a couple of minutes each to talk about yourself, what you are bringing to the table here, and then we'll get going. So let's start with Mark, because I'm going to be chivalrous.
I just handed the microphone to Ellen. Well, again, it's great to see everybody this morning. My name is Mark Holland with Pickwick Capital Partners. We work as an investment banking firm and capital raising for, companies as well as funds.
Hi, I'm Ellen Baker, and I have a company called Baker Aurora. We're licensed with Pickwick, so I know Mark very well. And I specifically do placing funds for high net worth individuals and family offices, and consulting to alternative family offices and alternative investment companies.
Hi, I'm Lindsay Sechelle Rubenstein. I will tell you that the oat milk gingerbread chai at Starbucks, you can't go wrong. It's like the perfect balance of everything. So that's right. Maybe I shouldn't say that. I have a wide-ranging background. Currently, I'm aligned with this wonderful family office. We helped build the World Financial Center, now Brookfield Place. A lot of what we do today, multi-billion-dollar real estate family office based down on Wall Street, is not surprisingly real estate. I work at Opus Capital Management, where the non-real estate alternative side, where we actually do pick managers that are uncorrelated to our real estate profitability. And that comes from a background where I worked at a fund of funds and hedge fund platform for many years, worked in-house at GE Shaw before that, and before that at Goldman. So wide-ranging 20+ year experience in public and private market across cycles. So have a thing or two to say about picking managers over the years. And I'm excited. Thank you to Marty. Sorry I missed the one in Art Basel, but I heard good things from my father who was down there. And I'm happy to be here with my friend Dee Dee, and yes, happy to be here.
And my name is Howard Cohn. I'm an advisor of Strategies for Wealth. We've been around for about 90 years. And I primarily work with entrepreneurs, business owners, and high net worth families on their multi-generational planning for business owners, their exit strategy, helping them to blend their personal financial life and their business financial life, and help them to look forward to the future so that down the road, everything is on their exit is much more tax efficient, and that their children, grandchildren, multiple generations can, if they like, enjoy the hard work that they've done, and also help them set up things for charitable organizations. Happy to talk to anybody about that. And getting back to what Mark said in the beginning, no advice. You can give the whole speech. Anyway.
Well, we'll just say the disclaimer has been restated.
Yeah, the disclaimer has been restated. So I've gotten to know Mark and Ellen over time, and happy to get to meet Lindsay now. I'd like to start this off by asking the three of you to spend a couple of minutes on what you each think of the current market and how that affects the work that you're either doing as managers or the picking of managers. And I'll start with Ellen.
The market's been hot, as you all know, and but at the same time, I found that a lot of family offices and high net worth individuals are just sort of wait and see. And first it was the pandemic, because a lot of the checks that are written to these funds are large. So a lot of it was, and you couldn't really close business on Zoom, in my opinion. And then it was, oh, the election, what's going to happen? Meanwhile, the market per se has been doing quite well. But as far as alternatives go, which is my field and a lot of our fields, I find that there's been a lot of wait and see. I do think that there's a lot of liquidity sitting on the back burner waiting for sort of January, see what happens with tariffs, see what happens overseas, see what happens with the various wars. And so we're all cautiously optimistic, as they say, for the new year.
I'll jump on, you know, what you said there. And I think it is a good take to kind of give the bigger picture before we jump into like the special sauce and secrets and where we're all investing. But yeah, I think going back, if we are going back to the pandemic and what happened there was a need to filter out the noise. At that time, I was at a multi-billion-dollar fund of funds. And you really couldn't do anything wrong. I mean, people were throwing like billions of dollars at us from all across the globe because we were just making money. All of a sudden, the pandemic happens, and there was a need for transparency, regulation, a rebuilding of trust. There was a healthy distrust of any third-party intermediary, such as the one I was working at, such as the one you were working at. And that takes time. Trust takes time to rebuild. There was survivorship bias. A lot of the regulation happened. And then I think something else did happen, COVID. I don't know where everybody was for COVID. I will tell you, patient zero worked in my building across from Grand Central Station. And when I called one of my coworkers and said, so-and-so, you know, I think goes to Temple with you. Do you know him? And he said, I don't know him, but they're somehow telling me to quarantine for 14 days. I went to the Dwayne Reed on the corner, bought out all of the hand sanitizer, and told my husband we were going to our safe place, which was 3 hours north in southern Vermont. And we spent from, I want to say that was about March 3rd, because I was actually at I was not at this conference. I was at a different conference, not as good as this one, which I rapidly evacuated. And then I started getting on these phone calls. I'd be on the phone with like Gert Dijkstra of the Dutch pension plan as my, you know, 2-year-old was running around in diapers. And I'm sure we all have our similar comparison of those stories. What really was happening then, going back to the big picture, right, was when we were going back to the GFC and that healthy distrust that was happening, where it was, you're a third party intermediary. You said you're going to get me these returns that were uncorrelated and can't go wrong. And we have like 50 billion MSCI Barra stress tests to prove us otherwise. And they all went kablooey, right? Now we're all cornered together with literally sandwiched together with multiple generations. And all of a sudden, there's that healthy distrust is reopening again. If there's that proper communication of what return attributes are supposed to be, transparency of results, and an understanding of what the portfolio selection process is going to be. It was very much like a help me please kind of environment. And that was another, I would say, sea change in the shift of how portfolio selection for a lot of not just family offices, multifamily offices, even RIAs, foundations, endowments, all the way up to bigger pensions who are trying to figure out ESG, for example, where there's now a lot of backlash on, you know, how to figure that all out. You know, where do we stand today? I'm going to kind of leave it at it. It's a balance between the two. And I want to let, you know, time for the next questions, and I'll certainly be happy to go into more details as my colleagues do, into a little bit more of our secret sauce and what we're looking for and how we're going about it. But I'll pause there for now.
I think you hit on some very important themes. First off, trust is huge, right? You don't establish that in one meeting. I find that companies we represent and funds we represent often think we have this nice warm network. We're going to make 3 phone calls and they're going to be funded. That's not reality, people. Just to be very fair with you, we will introduce you to people and you will begin to build relationships with them. If you have an idea that they like and are interested in, if you have the expertise, not just to execute, but perhaps the gravitas and contacts to make this idea go, then they will invest in you. And these are things that are proven over time. You know, every time you sit down within a family office or an endowment or a pension fund, you've got to start building those trusts. And certain pieces of their process are particularly geared towards that. I mean, if you go to a large pension fund, first thing they tell you is put it in our database, put all your information in there. So they have that, and then they have a meeting, go forward or not go forward. You don't even get to meet with them. Second thing will be if they take a meeting, then you begin having discussions about why your idea makes sense, what is, and how does it work? How are you going to make this work? And they begin judging you as a team. If you have a team. If you don't have a team, it's a minus right away. I'll tell you that. You know, but some ideas don't need a big team or a huge team. It doesn't have to be huge. It just has to be one that's credible and something that makes people say, yeah, I'm not going to lose my money being this. And then you have the final hurdle, which is where are you in the process with other families and raising the capital? Are you going to get it to the end line? That is another important piece of the trust factor, where you're going. And, you know, if you don't have all 3 of those things lined up and you don't walk them through that process and get them there, then you're not going to receive the money. It doesn't matter how warm my contacts are. It doesn't matter how long I've known you. You know, my thing was just to get you introduced, to get you taken seriously.
Yeah, so I just wanted to touch on what Mark was talking about now, and that's team and the importance of a team. And if you could also address how the advent, or it seems to me, the increase in the use of fractional CFOs, fractional experts, because right now you can find fractional in everything, right? From fractional sales managers to fractional CTOs, CIOs, and how that fits in. It sort of reminds me of decades ago, I was worked for a marketing firm, and everybody who worked on a project for a marketing firm for a campaign was a 1099. They came in and they wanted specific experts to come in. And is that something that you deal with on as part of your process?
Yeah, I'll jump in and start that. It kind of comes down to right sizing your needs for the time. So, you know, the advice will change. So sometimes, you know, we'll be advising family offices that are going through intergenerational transfer, and they don't have the ability. You know, we're a big fan of quality. Nothing stands for quality, you know, but if you're not in a position to hire a KPMG or a PwC, and you go for another great, but maybe second tier, you know, Cohn, Resnick, Eisner, Amper, which are still great firms, it's not so dissimilar that if you don't have the ability to have an in-house team, you know, for due diligence and everything, and you're relying on an OCIO until you come to a size or scale where you can do it yourself, that's an advantage, right? They're going to source you with more opportunities than your team can do yourself. You know, a couple of the secrets that I'll give you, right? We're all sitting here at the epitome of success. Well, that's not. But you know, it's Vince Lombardi who said the man at the top of the mountain didn't fall there, right? So one of the rules, and it's he's my mentor, he's a good friend. He was at my wedding, Tom Gimbel. He always told me, you know, let's simplify things, right? Not everything's so complicated. And he simplified it into the 4 Ps: people, process, performance, philosophy. All those are inextricably linked, right? So first, your philosophy. What do you stand for as an institution, as a family? What are your core values? From there, you should be able to define your return attributes. For our family office, our profitability stems from our real estate. Therefore, our non-real estate alternatives should probably be uncorrelated to real estate. That makes a whole lot of sense in directing our manager selection there, right? And so in terms of people, people is both internal people, the people you hire, right? That you see spend sometimes more than your family for good or for bad. But also the manager relationships that you're forming and how they weather different economic cycles. And we'll have managers that we will be with when they're underperforming because their positions make sense and we have conviction. There are managers that are performing in markets where they shouldn't be, and we'll all get out of the elevator and wait. If it's the 2 blocks, 5 blocks, whatever the appropriate radius is for your city, and we'll just kind of do a full cut there, right? So it's the people, the performance, the philosophy, and the metrics. The metrics really do matter in terms of what you're looking for, right? And so we tend to be very defensive, right? If we're making a lot of money from real estate, for us, and our hedge fund book is different than our private equity book. Our hedge fund book is like our ATM. It's a Warren Buffett's just do not lose money book, right? Private equity, we have a longer term, horizon there, but we still want every investment to be uncorrelated one from one another and also to a primary source of profitability there. So that's what I'll, talk a little bit about that. Is it there?
Well, I will say that, again, we're going back to the word trust, right? And one of the ways you can build trust with investors is by being smart about how you run your business, right? So if you don't have the expertise in-house, or if you don't have the possibility of having the expertise in-house, then, having an outsourced CCO, having an outsourced, I won't say CFO, I think you need to have that in-house, but maybe it's an outsourced, fund administration firm that does the basic accounting stuff for you. That will help you scale. That will help you grow. That will help you avoid those disasters that you would have stepped into had they not been there to give you the guidance. Because this space is filled with regulation. It's easy to trip over it. My compliance department is my best friend. I call them up every day and say, hey, I'm looking at this. This is happening. That's happening. I don't want to step in it. Did I step in it? Oh, no. You work really hard to try to stay out of those situations. I think it's important for anybody that's running money or anybody that's doing that, have a good legal team helping them, have a good accounting team supporting them, have a good, even a marketing team. If you're going to raise capital, there are placement agents out there that are excellent to supplement your internal IR people. And they should be working as a team. They shouldn't be, competing with each other in a lot of ways. Again, I think that's what attracts investors. I think that's what makes you smart as a business. In time, you might bring more of that in-house as you grow larger. But as you start out, especially if you're early in cycles, I think that's a great way to get going and to really begin to scale.
You touched on compliance, and I think that is a key one. I've recently been working with a cybersecurity company, and we got along the path for about 6 months, dotting the I's, crossing the T's. I went back and did thorough investigation, background checks, went through the whole 9 yards. What turned out after 6 months is that I didn't think to ask, did your attorney file the blue sky and the Form D? Who knew that an attorney wouldn't make this happen right away? So to your point, something can go bad very quickly if you don't have a great compliance source to advise you, be it in-house or be it outsourced. I'm a firm believer in that. And as we all believe, manager selection, first and foremost, is culture. It's who you're dealing with. Do you believe in them? Is there eye contact? Can you trust them? Do you feel like I'd put my own money in there if I were liquid, or I'd put my mother in there if appropriate. Is it something that you feel gut wise is smart and honest? And you also have to take a close look at what's the exit strategy. Have they thought about that? Or I believe in the company, I believe in the management, but I also want to get my money out sometime. What's the story here? So I think there are a lot of factors that go into manager selection. I happen to work with a lot of smaller managers. A lot of the family offices I work with, they already have somebody at Morgan Stanley or Bear Stearns or fill in the blank, and they're giving them whatever they can that's on the internet that's approved by their team at their big firm. I like to find little nuggets that they don't know about that I think are cutting edge, newer strategies, something that they say, wow, thank you. That is something I hadn't thought about, but what a great idea. That makes me feel good. And something I'd put my money in if I could be that liquid to engage.
I'm gonna add on to that. So this was back when I was in diapers, but the family office was doing okay. But it comes exactly to your point, Dee Dee, which is when we started coming out of our real estate profitability from the World Financial Center, we didn't start building our hedge fund portfolio based on who the big winners were. In fact, they weren't even, there wasn't even like a top hedge fund list or 100 women in finance or all these awards that there are today. It came from building relationships with the tenants of our buildings, right? And based on us, again, the 4 Ps, our core philosophy was, do not lose money. We want consistency of returns. We want high, and I know this was discussed in the last panel, I believe, high downside performance in negative markets, high sharps, and a close cousin to the sharp, but it's a geekier term, the Sortino, which focuses more on downside risk. All of those risk return attributes, lower deviation that mattered. We were selecting managers not for who they are now, for the return attributes they were delivering for us at the time. It happens that we more or less picked right, but going to the point where we go to find newer managers is not. We're not investing with a B-REIT. We're not investing with a Blackstone. We're looking for those managers that can deliver on those pockets where we're seeking return attributes, for where we see their potential for growth and for us to grow with them. We take a little bit of a departure than others in that we prefer to almost give up that free givesy where like somebody will say, we'll give you preferential terms just to keep you in a little longer, versus we'll pay the full fee, but we'll grow with you AUM wise and build the conviction and see how you behave and perform on cycles. Because going back to another saying that's kind of stuck in my head, and I don't know how many people have seen, it's an old movie now, it's going to date me, seen the movie Fight Club? Okay.
That's old.
I don't know. I don't know.
Yesterday.
Wicked just came out. I have no idea. But okay. So first rule of Fight Club is, don't tell anybody about Fight Club. Second rule. So, our first rule is never build a strong strategic relationship. Our second rule is C rule number 1. And that has served us very, very well.
I think, go on, Suzanne.
I just wanted to add on something that you said, Lindsay. I think it's really important. Because you mentioned process.
Yes.
We spend a lot of time on process, but making sure that the process is repeatable and sustainable throughout markets. Sometimes I think people get that a little bit confused. And the other thing I would add about Sharpe ratios, not always, it depends on the strategy you're looking at, whether it's a good metric, but back in the day when convertible ARB was like a very hot place to be, they all had high Sharpe ratios and they all blew up.
Right.
So believe it or not, there's a correlation between high Sharpe ratios and blow ups. So you really have to make sure it's true. you really have to make, and often it's as a result of leverage, right? Because you lever something and that can.
Leverage it, right. Leverage is another key point. Yes, consistency of process. You need repeatability. And whenever you go through these manager decks, and I know a lot of it looks like we're all copying each other. We all have that slide which shows start with this many managers and we get down to this many. We have a 4 or 5, step repeatable process, which cycles back because it's all true, but part of, the job of somebody who is allocating, when we're looking at managers to allocate and we're looking at those pages and those books and we're building those relationships, it is how true. Who's the person that's doing it? Let us talk to, and we actually do these kind of, call us crazy. We do these things. We'll talk to the MD, but we'll also talk to the analyst. Do they answer the same questions in the same way? Is there that consistency of process? These are checks that everybody should be doing because what is the culture and ethos of the firm that's not just in the book, but that's in practice every day?
And I'll say one more thing, which I tell managers all the time. I personally hate to see performance on the first page. Because as far as I'm concerned, it's that repeatable, sustainable process that results in the performance. So tell me how you get there and show me the performance as the proof, not the other way around.
Apparently, we come as a package deal today.
I was gonna say, yeah. So, a couple of questions about private equity style firms, there's kind of been like gridlock and exits the last few years. And I think Suzanne made a comment about, not really being able to follow each deal. It's just too much. There's so many deals out there. So you go to a fund manager. And any perspective on this kind of gridlock in private equity and venture capital that's been going on? And are you changing your approach? Are you looking at, top quartile, top decile? Are you looking at how they manage liquidity, et cetera? Any perspective?
I think one of the things you find from the conversations taking place today is not just how you achieved your IRR. It's not just what is your IRR, it's how you achieved it. Was it a bunch of secondary sales? Was it a sale to another private equity firm? Or was it sold to a company or did it go public?
Or did you sell it to fund 2?
Or did you sell it to
get
fund
out of
2?
fund 1?
Or a continuation fund to get it to get the results in your fund there. So there is a lot of people looking at the quality of exit, we'll call it here. I think also, something that as they were speaking comes to mind, and they're packaged here, but every family office is a little bit different, right? They all have their nuances. They all have what they want to invest in, and they have their own thoughts. So when you go to sell to them, you have to know them. And you have to have your presentation should be set up in such a way that it doesn't lead with, here's what I have to sell you. It should be, here's what I need to know about you. So before you ever open up the book, you should be asking them questions about their process, how they think. So you
100%.
derive those things before you start going into your discussion about what you have to offer.
Yeah, I'll add to that, for every conference I go to where I say we're a real estate family office, I'm on the non-real estate side, where in real estate we invest directly and are not looking for deals. And on the non-real estate side, we're looking for funds across hedge funds, PE, credit, opportunistic. The number of real estate funds who have not done their research, all that should displays your character. Use a few brain cells there. Sorry, I guess the chai has made me lose my filter a little bit, but
We like that.
but really in terms of, for us in private equity, it's given us, so going back a few years ago, it was like a race to you've got to throw your money in before it closes and you don't even get a look-see into the book-see. We have this ability now where we do get a look into one, from the relationship side, how are these managers that were touting their books so well and this performance that was doing so well, how are they handling this time period? What do their books look like? How is their pipeline sustaining? How proprietary is their pipeline? So that is very helpful to us. Also, we have not invested in secondaries to date. There has been a lot of business in that. It's certainly during the period post GFC, we got a lot of great positions from managers with which we still had high conviction on the secondary market. We just closed on, I would call it a hybrid-ish hedge fund / PE opportunity. It was almost an initial minority stakes on the RIA market. It was an industry where we saw strong tailwinds, right? It's undeniable the M&A that's going on in the RIA industry. It wasn't their first foray, so we weren't helping them acquire their first, RIA. They had already purchased about 90. So at the point we were coming in, their pipeline, because we got to look-see into the book-see, was very strong. They were looking to raise about 300 million. We wanted to take X% of it, no more. They ended up oversubscribing, but the beautiful nature of it, and I'm going to point to a couple of facets, is you're closer to the exit. So maybe we were giving up a little bit of the upside of somebody who came in day one, but we were still getting 20% net IRRs within a 3 to 4 year timeline between an IPO, or if you read in the markets, every big asset manager is trying to plug in where they're short on alts by acquisitions, right? So we have confidence in an exit in 3 to 4, and we're getting paid to wait. So for us real estaters that, that are not always working with a full brain, it's like a REIT without bricks where you're getting paid the dividend. Made a whole lot of sense for us in this type of environment to make that type of investment. Of course, we took time to get to know the team. We studied and stress tested the returns. So it's that art and science there. And it made a lot of sense for us. So that's another area we're finding interesting. And it's also those that kind of fall in neither land, those opportunistic opportunities like, and I know it's kind of like olives, you either have a taste for it or you don't, but like litigation financing strategies like that offer really truly uncorrelated returns. Credit we are careful with. It's a very crowded market. You really have to know who you're invested with, and then what their pipeline is and how proprietary it is. But I think that we do see opportunities there. Kind of, sucks if you've been in there and you're waiting for returns, but hopefully with the new administration, the IPO market signaling that things are going to kind of get better. But certainly if you're a new entrant now, we're seeing opportunity, but we're doing the research. We're not just like throwing a dart.
So if you look at the IPO market, there was 95 IPOs in total last year, 45 were venture capital backed, right? But even at our best time since 2008, there's been about 160 IPOs on average, right? In 1997, there were like 870 IPOs, right? I think about it, right? So
Markets there's a dearth of public companies right now. 87% of companies with over 100 million in revenue are private. And the Wilshire 5000 has like 3,684 companies in it now.
So actually a point that I wanted to ask during the prior panel was, he talked about, artificial intelligence mirages, let's say. A lot of these companies that are private, they go public and then all of a sudden their whole valuation drops through the floor. Just look at the record of SPACs, for example. I think 70 or 80% went negative, right? Maybe it's more than that. So are some of these private, we don't have full view or transparency into these private companies. Thoughts?
I just wanted to add to your point about look-see into the book-see. I think ever since Madoff, we've realized cocktail party due diligence is over with. Well, the world has to be very transparent now. I do my due diligence personally. I have a broker dealer that takes out the microscope and they do their due diligence. I have to tell you, it takes about 3 months before I can really bring on a manager. It takes a long time. It's not like it used to be where, he's a good guy. This is a friend of mine. They made a lot of money from this good guy. I think, why not? No, it doesn't happen that way anymore. It's look-see into the booksy very carefully.
Yes, I see a question and then we'll go back to your question.
I thought you have another question, Marty, I can go on.
No, just,
Yeah.
if you have a question.
So I was just going to go to your diligence and Marty.
Hold on.
Yeah.
This way, people.
No, just kidding.
I can be like, from
People online here. Sorry.
No, just sort of relating to what you said about IPOs and other things, I also wanted to ask the previous panels, as you look at opportunities or risks, like pandemics create risks as well as opportunities. And I come from the world of healthcare. There were numerous IPOs and SPACs, right, at that time. But now we know most of them didn't pan out. How do the fund managers take all that dynamic, macro dynamics into consideration?
Between 2017 and 2022, half the IPOs were healthcare.
Yes.
Absolutely. Last year, not so many.
I'll try to get to both questions. And one is like an interesting factoid that I guess hasn't been highly published, but like Fidelity, right? Like one of the oldest, slowest moving firms. And sorry if anybody works at Fidelity. I love Fidelity. It's great. But they have a $250 million venture capital fund that they've been raising. And when asked why, it's because they're not getting enough from the public funds that they're investing in. So when you see Fidelity making that kind of move, that tells you something about the public market dynamics and how firms like that are positioning. To answer your question, it's ironic because I do think there's a lot to be taken between the links between what's going on in health and wealth. Didi, you know this. Susan, you also know this. I'll give the example of when I was a youngster and I would like hurt myself, right? And I would go to the doctor. I would go to the doctor reactively, right? What's happening now? The shift is everybody's going proactively. There's also a shift between spot on, I hurt myself, my boo-boos here, to getting these full body MRI scans to say, where are my future boo-boos? A lot of that is actually happening with intergenerational wealth transfer and a shift between reactive and proactive and a focus not just on a bespoke stack investment or when is the IPO going to happen in this private equity investment, to focus on a holistic portfolio for the legacy. So there's much more a shift to longevity focus. So it's like a health span, wealth span parallel that I think we're seeing a lot more of. And I think that's one of the, when we talk about fad versus fundamental, that's one of the fundamental shifts that of that $84 trillion, 73% of the, whatever Gen Xers or Zers or YQs, whatever, or XYZers, don't believe that they can get above average returns from stocks and bonds. The face of wealth is changing. 30 trillion of that 84 trillion is going to women. Of that 30 trillion going to women for various reasons, gray hair, divorces, we happen to live longer. Sorry about that, dudes. We're going to outlive you. But also just younger women inheriting money. 85% of them want that money to be invested in a way that keeps them financially secure. 87% of them want to have a better lifestyle, right? Both of those require, given that 73% statistic, more investments in alternatives that actually are more longevity focused versus this one specific investment. So I do think that's going to be a shift that both affects family office allocations, the way RAs look at interacting with family offices. And it's also, quite frankly, I was actually talking to one of the managing editors at P&I magazine, like what the board compositions of the firms that are going to be setting the IPC, the investment policies, decisions for these big pension funds. So we were talking about this the other day, that it's almost like we're seeing a reverse of the Yale endowment model. It used to be like the good ideas started up here and then they trickled down to the smaller pensions and the foundations and endowments, and then the big family offices, ultra high net worth, and ultimately to the retail. Now it's the family offices, and through their collaboration with where we're sharing the due diligence. It's not like we're forsaking due diligence. It's sharing due diligence, through small forums and meetings and the like, and being able to act more nimbly when there's actually decent investment opportunities to be invested in, and not having that 9-month investment window, to get a deal done in 4 to 6 weeks by shared due diligence. So I think your point is a point well taken and a question well asked.
You have to be really careful when using other people's due diligence though, right? You got to make sure that it is done properly. They've dotted the I's and crossed the T's and looked at everything. You just can't take it on face.
You never trust another person's due diligence. You can use it to complement your own, almost as a check to see if they've come across the same points of alignment. If there's some disagreement there, it's a great check. It's almost like, I don't know, I was like a big dork in like high school and college. I would always write my own notes, but I'd share notes with my friend over here. I trust my own notes better, but was there something I missed because she caught something, that I didn't? There's great checks and balances there. And then sometimes there's power where we can collaborate and make bigger deals happen together if there's agreement there. Yes.
Well, I would just also,
Yes.
You finished? Yeah. Okay.
I would just add to that too, in terms of sharing due diligence after Madoff, right? My dad was a Wall Street guy. He made all his investments directly. He would talk to Izzy Englander and Stanley Druckenmiller and this one and that one. But he wasn't doing any operational due diligence, right? He was talking to smart guys. So after Madoff happened, I said, look, Dad, I sit across from 1,000 investors every year. I know who does good work and who doesn't. So from now on, if you're going to make an investment, let me go to one of these bigger institutions that's got a whole ODD team and check it out that way. Because sometimes you can leverage resources of people that you think are good at what they do. And I had an insight into that because they would give me the proctology exam.
And those resources are becoming cheaper and cheaper. You can get them as a partial, outsourced CIO, partial CIO.
And what I was gonna ask as a follow-up to all of this on the due diligence, and going back to the previous panel, and Marty touched on it also, is what, if any, influence and the use of the technology of AI do you use in your due diligence?
So AI, we use AI on many different levels, and it's a great question because I think so many people are focused on investing in AI through a VC early stage like Unicorn, but really we find it as a tool that's useful internally at the corporate levels, as a way to screen certain sets of data, but we never solely rely on that. There are always a second set of actual human eyes to check for errors. In the same way that we did after the GFC, we separated out our risk into portfolio risk and operational risk. There's a lot of, data that can be gotten through a whole lot quicker through the use of AI. But there always needs to be actual checks that go over that.
Absolutely. I would just chime in on that. We use it for a lot of market analysis and, to really double check what the firm's telling us about the industry and where it's going, how big it's fast it's growing. And it's a wonderful tool for that. Plus it can identify, potential buyers and sellers if the, and people who invest in the space. So it's a wonderful tool for those types of things, but you still have to have a face-to-face, sit down with them, talk to them about their process and procedures and things to that regard. Steve?
Yeah, what are the components of your due diligence? And for instance, would one of those components be determining the data that was used to come to the conclusions to arrive at the investment decision. Because that's key. That'll tell you why they succeeded, and if they can do it consistently, repeatedly or not.
Yes. Oh, well, yes, 100%. The repeatability and consistently, it comes down to, I'll give you an example. I was at a very big investment conference in Florida, sitting with one of my coworkers, and I was like, I think we just discovered a fraud. He was like talking about his investment track record, and we could see like the returns changing. And he's like, well, basically that's when we switched our strategy from being like small cap focused to being like more mid to large cap focused. And I'm like, you didn't separate out the return streams or footnote that or like shade that in as anything. Like there's a fairly big difference there, right? So a huge part is, again, this comes back to the P, which is the people. And one of the most, you talk about returns being, probably the most valued currency. I would argue that the currency of relationships is probably one of the most undervalued, but most important currencies there are. And as you're building a relationship with a firm, that becomes readily apparent. Usually it's not that quick, but we've had longstanding managers where, let's see, I remember one where they started investing. It was a manager we liked a lot. They started investing in a lot of smaller micro cap overseas companies, weren't changing their liquidity profile. It was becoming a larger part of their book. And we were getting concerned, and they just kind of gave us a layman's answer. And that was one where we just kind of universally said, this does not smell good anymore. There's a deviation. Sometimes you call it style drift. There's a deviation or a chasing of something to achieve a return that they want, but doing it differently than they used to do. And they don't have a justification for it. Sometimes there's a justification for it, that there's again, a fad versus fundamental. There's a fundamental shift in what's going on in the market, and it's okay, right? But to your point, yes, definitely checking on the repeatability of the investment style and how the returns are achieving. And that goes back to, it's on us to retest our modeling of their investments. So good question.
So one of the things that you sort of you did touch on, but I'm curious about, again, working with multi-generational families and what the role of the first generation and how they're sort of either stepping aside or being pushed aside, and how you've been dealing with that sort of as a family negotiator. Ellen, do you have any thoughts on that?
Well, you have to pay attention to the next generation, because if you have a relationship with the parents or grandparents or whomever, you have to be very careful that you keep up and educate and stay close to the next generation, because they have different ideas. I mean, as Suzanne said earlier, the younger generation cares about plastics and cares about the environment and the climate. And I don't think our parents knew or thought about how important it was to care. And if you don't show some empathy towards their feelings and their desires to make the world a better place, rather than just make money, if you don't pay attention to their passions, then you're going to lose the client, period.
It's a long-term process, right? It's not something that happens in a day. So as you teach your children to grow and become adults, right? You need to do the same thing with the financial world. And Sammy Dweck, Marty's had it up here several times, does a wonderful job. He's a person who does advising to family offices, particularly around this issue. And it's really how to get these family conversations started, how to get it really looked at, and how to bring them along. You have to create safe spaces for them to fail. But you don't want to fail with the big egg. You just want to fail with small pieces as they grow and learn and do things. So I think it's a process and has to be really well thought through. And I don't know if that's what you're experiencing, Lindsay, or not.
So we happen to have a very large family office. We're fourth generation, 651 now. We just had a new generation member born. We're highly reproductive. I'm not part of the family. I only have two little kiddos. But what I will add to that is we are seeing it. My 11-year-old has a good voice. I don't, but you know that, what is the song like? Teach the children, let them lead the way. The best kind of forms of governance, and this comes down to the, F philosophy, are those that happen to bring the younger generations in early to observe, not always to copy, but just to observe how it's being done and then be able to see what makes sense as the world evolves. But there are definitely differences. And I'm going to speak very broadly because it certainly changes. I kind of refer to it as Forrest Gump. Life is like a box of chocolates. Like every family
never know what
office,
you're
you
gonna
don't
get.
know what you're going to get. A lot of first generations tend to be very VC return focused because they're coming into a lot of money that they didn't have to do a lot with. So it's like they've kind of just come into a lottery, right? What we hear, Surrey Cruz just came into $1 million like yesterday, right? How is she going to invest that? But more prudently in the family offices that are more glued together, there's more of a stringent philosophy around how to manage that or how to turn parts of the businesses that were not necessarily generating revenue before into revenue generating components. A good family office friend of mine who's not here today works for another big real estate family that was focusing on California. Now his pivot is he's focusing on Florida and the East Coast and building, generating revenue there. What's happening in our family office is we've made a lot of money and continue to do it on real estate. How can we generate more revenue on the our non-real estate alternative side? We have a lot of family members and friends that are aligned with us, and how do we take a look-see into what operations that we can improve? And it takes a good second set of intelligent eyes, so often within the family. Our Opus business was seeded with $25 million from our founder, right? So, there's intergenerational synergies that do occur. It seems the best ones that go smoothly are the ones where they're brought in early and there's a communication component, which does not mean like happy Brady Bunch agreement all the time. Trust me, I've witnessed that as well.
So
Sure,
we,
member.
we have about 5 minutes left, and it was touched on in the previous panel. What effects on this whole process do you feel that the incoming administration might have? And also, you can touch on this part second if there's time, actually, what the effect of potential tariffs might be on how you are vetting companies, et cetera.
Well, I'll start because one of the areas that we do a lot of work with is in the military and security and defense companies. And right now that is really going very strong in for us. There's a lot of the activity happening. A lot of the, points we discussed earlier about the need to secure our supply chain and things along those lines are, being looked at very seriously by a lot of people. A lot of big investments are being made in those. A lot of the world conflicts are driving this at the current time too. The need to continue to be advanced and ahead. And also it's been something that's been kicked to the curb by ESG a little bit, right? A lot of our institutional investors abandoned this area. And it was thought not to be a good area to invest in. And, now they're coming back, realizing that, we've lost some ground here and we need to really get more involved. So it's been something that's been interesting, a change in dynamic. I don't think it's the new administration rode the wave of that more than the new administration brought that to the fore.
I see a shaking of the head here.
Well, I think security is an enormous issue. I mean, you look at casinos, you look at banks, you look at healthcare. Every day we're hearing about billions of dollars that have been lost because of security breaches, which is why I was head over heels over the security company. But, then I had to bow out because of, certain legal problems with the compliance. But I tell you, we are going to focus totally on trying to be secure. I mean, you look at your personal life, you look at your bank account, you look at anything that you buy or do, you want to make sure that things are secure. And that's a huge issue going forward.
Yay or nay, health and wellness companies now that RFK Junior is coming in.
They what?
Are you positive on like, there's a lot of wellness funds out there, health and wellness funds?
Yeah.
You positive on that, negative, or it does not impact you one bit?
Depends on the fund.
Okay. You think it's an opportunity?
So I think there's an huge opportunity in the health, wealth, and legacy movement. Like I said, I think health span and wealth span and this whole trend toward longevity are intertwined. But and this happens across any movement, right? Or fundamental shift that occurs, just because there's a movement that happens doesn't mean A, B, or C fund is the right investment. You still have to you can't forsake your due diligence. Going back to the prior point, I think there were a lot of votes before the elections. If you saw, a lot of the biggest hedge funds were already voting pro-Trump before it even happened. I think there's a lot of hope that the IPO markets will open up. I think there's a lot of hope that there's going to be a lot of pro-business tax moves that will be very favorable for businesses such as those that we happen to be involved in. Time will tell, but it seems to be more positive than if it went, and this is not my Democratic or Republican view. I have, my own views. But it seems to be favorable for our types of industries and investments, giving a lot of democratization to those ideas.
However, the jury's out on these tariffs, and I'm very much looking forward to hearing the experts speak tomorrow, because it's scary to think about how does that work exactly? It's going to come out of my pocket somehow.
They're not new tariffs, right?
No,
We've used
no.
them before.
Way back when.
I also
Yeah.
think Trump's been great at rhetoric, right? And being out there and using this as a tool to get compliance from other nations. You could say it's worked in Mexico to a certain extent. So, I mean, I think we have to watch and see what happens, what really happens, as opposed to the hype that is out there before the things happen.
Yes.
Anybody else have any questions from?
Just
the-
a
okay.
plug, I think Dee Dee mentioned it tomorrow. I have two of my colleagues that worked on one was a commissioner on the International Trade Commission. She's an expert on trade, and she's going to be talking about tariffs tomorrow for about a half hour. For those of you that enjoy a nice leisure Sunday morning as well and enjoy CBS Sunday Morning News with Jane Pauley, I'm a big fan. They had a great 10-minute segment on tariffs and discussing ins and outs.
Yes.
So it was very, I'm sure there's a lot of other programs discussing it but if you tune in tomorrow morning, I think they're speaking for about 25 minutes.
One last, Steve.
I just want to make a comment. Whenever you're going to sit down and negotiate, for whatever you're going to negotiate, always understand what the other side has leverage over you on and what you have leverage over them on, and then see how you're going to bridge that gap. Because if both of you don't walk away from the transaction happy, you got a problem.
Yeah, for sure. 100%.
Well, great job, guys.
Thank you.